Hello, everybody, and welcome to the Like Totas channel. Happy Thursday to all of you, my dear viewers. I'm sharing you now my screen here on eToro. For those of you who are new to the channel, welcome. I always use eToro for educational purposes. And I use interactive brokers to execute all of my transactions. That said, I can see that the markets are already bleeding, which is fantastic to witness. Okay, everybody. In today's video, I want to break down Mercado Libre. So many of you left comments asking me to delve deeper into this company's financials and to determine whether or not they have a moat. That is exactly what I intend to do in today's video. Okay, well, I did some due diligence on the company in the past, but it has always been very expensive. I understand. So many quality investors are already invested in this company, and now many of them are already in the red because the stock, as you can see right here, I'm sharing my screen, is down some 40% from its all-time highs. So the question is this another broken momentum stock, or do I think there might be some opportunity for investors like us, like a tortoise type of investors? As always, if you find the content insightful, please make sure you smash the like button. It really helps the channel to grow, and that means we are doing something valuable, which is at the end of the day what really makes my days. Okay, everybody. So for those of you who are new to Mercado Libre, this company is known as the Amazon of Latin America. They operate mostly they generate most of their revenues in countries like Brazil, Argentina, and I don't know what the other country is. So bear with me 1 second as I will flip this to the stock analysis platform that you can see right here. They operate online commerce platforms in Brazil, Mexico. That's the country that I was missing. Argentina, and internationally. They operate Mercado Libre Marketplace, which is an online marketplace commerce platform that can be accessed through mobile app and website, in Mercado Pago, a financial technology solution platform which offers comprehensive set of financial technology services to users and other users of its e-commerce platform. It also provides Mercado Fondo that allows users to invest funds deposited in their Mercado Pago accounts. I'm going to tell you something. This company is tough to understand. So the first thing that I want to do before we delve deeper into this stock is make sure that you understand exactly, for those of you, if you are really interested in this company, and if the company is already in your portfolio, then I'm assuming that you already understand exactly how the company makes money in its different business segments. And if you don't understand that, then you shouldn't have invested in the company in the first place. And I know that think about Amazon and PayPal combined into one company, and that's probably similar to what Mercado Libre is. And it's a tough business to understand, different business segments. They are growing like the weed, which is fantastic to see, as we will discuss. But it's a complex business, and that can create difficulties at the time of understanding, for example, the value to put on this company. All right. Cool. So let's talk about its financials. First of all, let me open Stock Unlock right here. So I always use Stock Analysis or Stock Unlock to delve deeper into companies. And this one won't be an exception. Let's flip this to Mercado Libre. And let's see what we have right here. Right off the bat, you can see that Stock Analysis gives this company a 4.5 out of 5 score, which is quite high. Right? You can see they score high across different metrics, namely profitability, management, growth, financial health, analysts, valuation model. So the company is down 40%, and probably it's trading at one of its cheapest valuation levels ever. In addition, you can see that looking at the fundamental score of this business, you can see that despite the drop, the fundamentals have remained intact. Okay, this is very good. This is exactly what we want to see. We want to see that there is a discrepancy between the price and the fundamentals of the company, because this is where we like a tortoise type of investors can make a lot of money over time. Cool. Let's move right here to the financial tab. And starting with the income statement, you can see that total revenues going back to 2016 have grown exponentially at 46% compounded annual growth rates, which is incredible. Also, look at operating income, which has been negative. In fact, it was negative until 2019 and turned the corner to profitability in 2020. This, in and of itself, for me at least, is not something that I like to see, because I like to see companies with at least 10 years of financial data and profitability as well. And this company only turned the corner to profitability in 2021. Look at that. So this is earnings which have been absolutely exploding since 2021. So if I zoom in on this, because it doesn't make sense to look at it prior to 2021, you can see that, in fact, yeah, you can see that the CAGR for earnings is around 121%, which is absolutely mental. Looking at the diluted shares outstanding, you can see that there was a slight dilution going back to 2016. Yeah, it not too much considering the growth rates at which the company have been growing. So I think that dilution did create shareholder value. It's important to notice that, but they stopped the dilution, as you can see, and it's been rather stable since 2021, and now recently. So it's from 2020 to 2000 to where we are right now. You can see the total change is only 1.72%. And now recently, I think they announced a buyback. It's something very minimal. I think it's only 4 millions, if I'm not 4 million worth of stock repurchases, which is going to make a dent. But still, it's nice to see that they are doing buybacks, however small, given the fact that the companies potentially, will have to look at it, but potentially trading at multi-year lows. So looking at the metrics, everyone, let's have a look at that, because that paints a picture for us. And what you can see is that gross margins, which reached a high not that long ago, around 50%, are now down to 44.50%. So there has been some margin pressure right here. Okay, it's important to bear in mind. If I flip this to the quarterly time frame, you can see that margins continue under pressure. Okay, so those of you interested in the stock, make sure that you understand why this is happening. In addition, if we go to operating margins, take a look at that on a quarterly basis. This thing continues to come down. In the recent quarter, they did uptick a bit, but based on my understanding, they are sacrificing short-term margins. Margins are taking a hit because they are growing the business, and that they are doing that at the expense of margins, at least in the short term. And you may find this weird, but I don't dislike that. In fact, I invest in other companies that go through the same situation. The only difference, of course, is that they have a long track record of profitability, and that is not the case of Mercado Libre. But for example, Evolution AB is a company that, despite the great margins, they have faced some margin pressure as of recently, and the CEO says that he has no problem sacrificing short-term margins because they are still a lot of growth runway. It makes sense for them to reinvest a lot in that case. And in addition, the net margins are also taking a hit, but I don't expect net margins to be very high for an e-commerce company. And they are still at the core an e-commerce business. So yeah, similar to Amazon, so they will never boost exceptional net margins. But yeah, so they are still under pressure, as you guys can see. But on a quarterly basis, they have actually improved slightly. Right. So another thing that I want to see is, let's have a look at the balance sheet, and you can see, so assets minus liabilities gives us the book value. Book value has been on an absolute tear since 2020, compounding at around, well, it doesn't make sense. Look, Yeah, so it was negative for a while. Again, it only makes sense to look at this company from 2022 onwards. Yeah, exactly. You see what I mean? So let's change this to the yearly. Yeah, and you can see that since 2022, this thing has been going up as well. But again, I don't. I would like to see more of that, right? Going back and actually see several years of consistent growth. Cash flow statements, you can see the cash from operating activities has been going up. Look at this, right? Exploding since 2014, which is great to see. Stock-based compensation has gone up. I don't really like to see that, even though I do believe it makes sense for them to create incentives other than just cash incentives, right? It's nice because they want to attract talent. It's also nice to align the company's mission and vision to so to align them with employees incentives, and that's important. So stock compensation can be positive as so long as the company does not overdo it. And right here, I don't think that is the case at all, because if you look at the share-based compensation as a percentage of operating cash flow, it sits at only 2.50%, and as a percentage of revenue is less than 1.05%. Okay, so this is nothing. So when you calculate, when you adjust any free cash flows, you don't. I mean, in my case, in my opinion, it doesn't make sense to subtract that share-based compensation from free cash flows, because this is not really over. They are not overdoing it, if that makes sense. Let's continue right here. And so right off the bat, what you guys can see is that there is a big discrepancy between net income and free cash flow. Take a look at this. Free cash flow sits at almost 11 billion, while net income sits at about 2 billion. Why is this happening? This is because of the business model. And this is one of the things that may trick many new investors. They will use, for example, free cash flow when it comes to assess the intrinsic value of the company, but that is misleading. Free cash flow in the case of this company is misleading, and I actually made a few notes that I want you guys to pay attention to. Look at this. Free cash flow, okay, free cash flow is being boosted by working capital dynamics and the add back of non-cash credit provisions. So this, what happens with this company is that they are also becoming a financial company. You have to understand that. That's one of the business segments. So that means, as a financial company, they take on deposits. And that can give the impression that the free cash flow is growing a lot, which is misleading. So it's not free cash flows of the core business operations that are growing. It's simply the fact that they are taking on deposits. Nothing wrong with that. I want to make that clear. But you have to factor that into your model when determining the intrinsic value of the company. So free cash flow is not the right metric to use in the business. That said, part of that discrepancy that we see between these two metrics also has to do with working capital dynamics and the fact that the company they probably have bargaining power with suppliers for one. And in fact, if I go right here to the to stock analysis and financial stat cash flows, you can see that changes in accounts payable is quite high right here. This can signal favorable bargaining power with suppliers and also operational efficiencies. So that's why I made that note right here. Free cash flow is being boosted by working capital dynamics and the add back of non-cash credit provisions. Here we go. While working, what does that mean? You add back credit provisions because they act as a company, right? Because they act as a lending business, then they have to create provisions for potential losses, and that depletes net income. It's an non-cash expense that depletes net income, but is added to the operating cash flow. That said, those real losses can definitely materialize. So this is not like depreciation or amortization. No, they can actually turn into severe losses. So you shouldn't. This what this does ends up doing is, of course, overstates the free cash flow power, the real earning power of the company. As a result, reported free cash flow likely overstates the company's true earning power, making a normalized or adjusted free cash flow a more appropriate metric for evaluation. And what else did I find? If you go to the company's investor relations tab, and if you go to the latest earnings presentation, you can see that they actually have an adjusted free cash flow measure, and it's more aligned with net income. While net income sits at around 2 billion, the adjusted free cash flow measure, which adjusts for these loans and loans receivables, as you can see right here, among other things, comes in at around 1.5 billion. For the sake of simplicity, I will stick with net income. Okay, when determining the real value of the company, I will stick with net income. Okay, so that said, what else did I want to show you? Let's have a look at the returns on capital of this business. And what you can see, where is my intrinsic value? Okay, so this is the tab, my intrinsic value calculation full model template. Look at these numbers over time, guys. This is staggering. So Royce currently sits at around 11.55%, which is not great, but again, it's understandable considering the investment cycle in which the cycle through which the company is going, right? So the 3-year average is 11.66, the 5-year average is 8, the 10-year average is 6. I do expect the ROIs to continue to improve as the company becomes more mature. And by the way, what I also want to flag, guys, is the stage at which this company is at. This is a different company from the ones that I typically analyze because I am personally more lean towards investing in companies that are either returning capital to shareholders, so more mature businesses, right? And that can include, for example, companies that are just turning around. I don't think they are in decline. I don't invest in any company that is in a decline mode. I invest in either companies within the operating leverage segment, but by far the ones that I prefer include capital return. This stage, as you can see. Okay, and the stage at which the company can be found, of course, determines the valuation, the metrics that you will use. Okay, so just keep that in the back of your mind. Look at the book value growth over the last 10, 5, and 1 year, staggering. Same thing with earnings per share. I don't really pay too much attention. I mean, we can, but look, 10 years is around 32%, but it's quite noisy, as you can see, right? Quite noisy, because remember that the company was unprofitable the company only became profitable since 2022, which of course skews the PE during the past 5 and 10 years. So I don't put too much, a lot of emphasis here. But look at the sales growth rate, absolutely staggering, right? Okay, so also something that I want to flag. Let's go back. I want to. What else did I want to show you guys? Let's have a look at the insiders, what the insiders are doing. And it's nice to see that the founder and CEO is right now I think he's the executive chairman, if I'm not mistaken. He's definitely not the CEO. I think he passed that baton. But he still sits on the board of directors, which is something that I like to see. But you can see that ownership is high. Right, so let me change this. It's taking a while, bear with me. Ownership, come on. Yes, show only company executives. This guy, independent director, owns about $162 million worth of stock. So we have several people owning several millions of dollars, which I like to see. Okay, and some of them have even been buying shares in this downturn, which I like to see as well. Cool. what else did I want to share with you guys? Also, from a valuation standpoint, if we look at the forward P metrics, remember I will stick with net income because just for the sake of simplicity, not least because it's more or less aligned with the adjusted free cash flow that the management team reported. Okay, so I will stick with that in my evaluations. But if we check the forward PE of the company, they currently trade at the forward PE of around 30. So let me show you that. It's taking a while, bear with me. Okay, here we go. So they trade at, looking at the ratios right here, you can see that the forward PE currently sits at about 31 times earnings. And this, based on my research, since 2022, the average PE, again, 2022, because that's when the company became profitable, the average forward PE of the business is around 68. And right now, the forward PE sits at 31, which can signal undervaluation. Okay. So yeah, you can see that, which is a positive. And the same goes for every single other metrics that you want to highlight, that you want to analyze. So for example, let's go to our free form right here on stock unlock, and look, based on a price to free cash flow, and you already know that free cash flow is not the right measure, right? But we have to use the adjusted version. But based on this metric, you can see that, let's zoom in right here since 2022. Let me change this to the yearly time frame. So since 2022, yeah, look at that. What's happening is that the price to free cash flow is declining sharply, while the free cash flow per share is actually going the other way. So this is something that I like to see. In addition, if we use net income, okay, net income, come on, net income, what? Okay, so net income is here. So I want price to earnings. If you use price to earnings, you can see more of the same since not 2021. I want to see this since 2022. Right here. So you can see that right now we are at one of the lowest levels as well. In fact, lower than this was back in March 2026, not that long ago. Wait, this was the 24th. So it's slightly higher today than it was just a few days ago, right? Because I'm recording this on the 26th. So yes, definitely becoming cheaper. And the reason for this sell-off is again comes down to the fact that they missed on profitability expectations, exactly because they are using their operating expenses have exploded, and so did capex, and that is costing profitability in the short term. But what we want to see is that all those investments will eventually translate into higher profits, okay, and higher ROIs going forward as well. Okay, so let's now do something here, guys. I want to do something different. So what do we know so far? We know that the company boasts great financials. The only thing that I don't like as much probably is definitely the fact that the company hasn't been profitable since before 2022, which means we only have a few years worth of profitability. So this is not ideal for an investor like me. And right, so but still, it's a great company. There's no doubt about that. But what it means is that I would want a bigger margin of safety, and I will walk you through my reasoning going as we move along this video. So if I go to our stock analysis right here, what you can see is that yeah, look at this. So the returns on invested capital and so forth have been declining exactly because of the investments the company has been making. This is the trailing 12 months time frame. But over time, you would expect these, as the company becomes a more mature business, to reverse its course. But that said, I mean, I can see this thing going up already, right here. But let's change this to the quarterly tab to see what we see exactly. So look at this. Since September 30, 2025, you can see that this thing has been going up across all these metrics, which is nice to see. Okay, so like that. Yeah, so what else did I wanted to show you? If we go right here to the statistics tab as well, what I also don't like to see as much is the fact that they have a net debt position, so not a net cash position, right? So they are net debt because the total debt is around 11.42 billion, while cash and cash equivalents is only 6.31 billion. When you do one minus the other, you have a net debt position, which is not ideal. But again, I think this is well covered. What else do I want to see? Look at the margins. This is important as well, and I have all of that right here in my sheet as well, because I like to combine all the most important metrics into a single place. Gross margins at 44%. This is good. So all of that, okay. An interesting thing from a capital intensive standpoint, you can see that capex as a percentage of sales is below my preferred threshold of 5%, which is good. Capex as a percentage of operational cash flows is below my threshold of 15%, which is also good. And by the way, for the capex measures that you see right here, I use maintenance capex instead of total capex. And so you can use this metric right here as a proxy. If I go to financials, cash flows, trailing 12 months, you can, instead of using the capital expenditures, this whole number, you have to take into account the fact that a lot of this is actually growth capex that is going into growing the business, right? Building new warehouses, whatever. And so use the depreciation and amortization as a proxy. This is the number that I took. And when you do that, you get these two numbers that you can see right here. In addition, look at the debt to free cash flow. Again, free cash flow is misleading, but still this is below 1. And if you look at debt to earnings is 5.70. This is below my preferred 3 times earnings. So I'm doing debt to earnings here, so debt to net income instead of debt to EBITDA, because I'm thinking as a shareholder, right? And so yeah, and typically I like to see this under 3. So 5.70 is a stretch, but it doesn't immediately exclude this company from my watch list. And the reason for that is because over the past few years, their debt has gone very high. Let me show you that. Look at this. You can see that right here. You see the debt exploded since 2024. So make sure you understand why this is, but it's probably down to their expansionary efforts. And okay, let's go back. Look, also the interest coverage ratio is 20, which is good. It means the interest payments on the debt are well covered by operating income. That's a positive. In addition, you can see, what else can you see? Yeah, I think these were the most important things, guys. And now, so we talk about the company's financials, we talk about the company's management team, and the fact that the company is still closely is closely followed by its founder and previous CEO, which currently operates as the executive of the board, if I'm not mistaken. And then what else do we know? We know that from a relative, so using relative valuation metrics like the price to operating cash flow, price to earnings, and primarily forward PE, because as you can see right here, when a company is within stage 4 operating leverage, and that is probably where I see this company in. One of the metrics that you should use is the forward price to earnings, so the PE, right? The forward price to earnings, and it's currently trading at the cheapest valuation level ever since the company became profitable, which was only a few years ago. But what's staggering for this business is that if I show you right here the statistics tab, you can see that revenue growth is forecast at 19.52% for the next 5 years, and earnings per share growth forecast comes in at 35% for the next 5 years. I mean, what does that mean? It means that understandably the PEG ratio is under 1. How do you do the PEG ratio? You do the price to earnings divided by the expected growth rate for the year ahead, as you can see right here. And because analysts are expecting much higher growth compared to the current PE, that causes the PEG ratio to be under 1, and this is another potential sign of undervaluation. But this, I don't really pay too much attention to that, because let's say a company has a PE of 50 and the earnings growth for next year are 60. This is ridiculous, right? It's over optimism right here, and still causes the PEG to be under 1. Is that cheap? Not in my world, but it's what it is. So let's do something cool, guys. I want to show you something, an easy way to calculate the expected return that we are expected from this company, and you can do that right here. So you do the earnings per share growth plus the dividend yield minus or plus changes in valuation. This is in theory, it's easy to calculate the expected return, the return you should expect as a shareholder, and this is a quick way to do that. So let's assume the company is going to grow its earnings per share by 15% over the next 5 years. Over the next 10 years. They don't pay any dividends, so the dividend yield is actually 0. And then the current PE sits at about, 41? So the current PE sits at 41. In 10 years, I expect that PE to decline from 41 to about 25. And when you do that, how do we do that? Let's come here to our compounded annual growth calculator. Let's do 41 here. So 41, and now I expect that to decline to 25 over the next 10 years. And when you do that, you get minus 4.83%. I mean, no, actually, this is not accurate, because we should include the forward PE right here instead of the current PE. So let's do the forward PE, and the ending value right here is 25, right? So it will decline from 31 to 25 in 10 years. And when you do that, you get about, it's calculating, I think, is this 2 point something? Minus 2 point something. Let's see. Why is this taking so long? So, yeah, while we wait, I do think it's minus 2%, give or take. So when you do that, 15, it's minus 2%. And this all translates, yeah, look, right, spot on, minus 2.13%. So it's 2.13%. And when you do that, of course, you are left with what? Let's do, so that's, simple math right here, but 15 minus 2.13, that leaves us with 12.87. 12.87 is the expected return you can expect at current levels if these assumptions are correct, and if you buy the stock today. And in my world, this does not make the cut, because I want to get at least 15% of my money so 15% of my money, which means a double every 4.8 years, 2 doubles in 10 years, right? So this is not enough. The stock is a pass for me based on these assumptions. Last but not least, let's use our intrinsic value model right here to calculate, number one, the to calculate the current growth implied in the stock price. So that's the reverse DCF. But also, I want to see. I want to see. I want to do a DCF analysis on the company using net income, right? As my as using net income instead of free cash flows. So let's go there now. Here we are, and you can see right here. So I'm using the net income around 2 billion. I'm assuming 15% growth over the next 10 years. And when you do that, what you can see is that the intrinsic value per share is around the intrinsic value per share is around 728.76, and the current price today, as you guys know, is around 1,639, as you can see right here. So for me, this doesn't meet my criteria for a high quality at a margin of safety price, exactly because of what I want to achieve with all of my investments. And you guys know that I demand a desired return, which is the discount rate that I use, of around 15%, because I want to double my money every 4 to 5 years. So when you see people saying, oh, but the company is cheap, the reason they say that is because most people use the WACC as the desired return. And the WACC of the company, if you go to stock analysis and statistics tab, is around 9 or 10%, around 9%. If you do 9%, right, look what happens to the intrinsic value per share. Boom, it goes right up to 1,688. So if you are okay with a 9% annualized return, then the company is a buy today if your assumptions are correct, and the company can grow at 15% per year over the next 10 years. I want the margin of safety built in, and I want to double my money every 4 to 5 years. I use 15%, not 9 or 10, and that, of course, brings the intrinsic value per share down. Now, some of you will say, Ed, but 15%, the company has grown at 30%, at 40% over the past 5 years. Why don't you move that up? Because if we do have a recession over the next 10 years, what do you think is going to happen to your 15 to your 30% projections? Exactly. That is over optimism. And I don't like that, because this module, guys, will protect you on the downside while maximizing your returns as well. And if the company doesn't go there, doesn't go that low, never mind. There might be better opportunity. In fact, there are certainly better opportunities in the market. Right now, this is certainly not an investment that I'm interested in. So I think it's a very good company. It's a company that it will continue on my watch lists. I will keep a close eye on it, but I just think they are better and higher users of capital in this market, and so not yet for me. Okay, but look, certainly for those of you guys who are okay with we are less conservative than me, then yeah, I mean, you can consider buying the company today. It's just not a like a tortoise type of investment. Okay. Guys, if you find this video insightful, please make sure you smash the like video. Let me know in the comments below if you liked it. In addition, don't forget that we have our live call this Saturday on the 28th at 10 a.m. London time. So you can come live, ask me any questions that you may want, like we've been doing at the end of every single month. I always have a blast, so hopefully I will see as many of you guys there as possible. And that's it. I mean, that's pretty much what I wanted to say here. I don't think that I'm missing anything else. Yeah, stay tuned for more, everyone. And thank you so much for tuning in.